What if I told you that the smartest people on earth almost destroyed the global financial system? These weren't amateurs, these weren't scammers, these weren't gamblers. They were billion-dollar traders and the brightest minds in finance. They were Nobel Prize winners. Yet, in just a few months, they lost over $4 billion and nearly took down the world's financial system down with them. It was in the year 1994. On Wall Street, a new hedge fund was born, and its name was Long-Term Capital Management, or simply LTCM. From the beginning, it was different. Its founders weren't flashy, they weren't selling dreams, they were selling mathematics. Their office wasn't filled with people shouting across the trading floor. It was filled with equations, probability models, and computers. The people running the hedge fund had resumes that seemed almost unbelievable. Former senior traders from the biggest investment banks, leading economists, and 2 Nobel Prize winners in economics. If anyone could beat the market, it had to be them. Investors believed it too. Within a short time, billions of dollars poured into LTCM. The fund became one of the most respected names in global finance. But how did they make money? Their strategy sounded almost boring. They looked for tiny pricing differences between similar financial assets. If 2 government bonds were priced slightly differently, they would buy one and sell the other, and wait for the prices to move back together. The profit on each trade was tiny, sometimes just a fraction of a percent. To make those tiny profits worthwhile, they borrowed massive amounts of money. And this is where the danger began. Imagine you have $1. Now imagine you borrowed $25 more. Now you are controlling $26. If your investment goes up a little, you make a fortune. But if it goes down even slightly, your losses become enormous. LTCM wasn't borrowing a little, it was borrowing a massive scale. With about $4.7 billion of investors' capital, the fund built positions worth well over $100 billion, while its derivatives exposure reached the trillions of dollars. The model said it was safe. The math said that the odds of disasters were incredibly small. Then came 1998, the year Russia shocked the world. The Russian government defaulted on its domestic debt and devalued the ruble. Panic spread across the global market and investors rushed into the safest assets they could find. The relationships that LTCM's models relied on suddenly broke down. Assets that were supposed to move together moved further apart. Every day, the fund lost hundreds of millions of dollars, and their computers kept saying that the market should go back to normal, but it didn't. The losses kept growing, the bank began demanding collateral. LTCM had to sell all assets. But selling pushed prices down even further, which created even bigger losses. The smartest people on Wall Street had entered a vicious cycle, and by 1998, LTCM had lost almost $4.6 billion. The financial system faced a frightening possibility. If the fund should collapse suddenly, the bank that had lent its money could suffer huge losses. Markets around the world might freeze. The problem was no longer one hedge fund, it was everyone's problem. That's when something extraordinary happened. The Federal Reserve Bank of New York called the biggest banks on Wall Street into a meeting, not to bail out LTCM with taxpayers' money, but to persuade the banks to work together to inject more capital into the fund. The banks agreed. The rescue prevented a disorderly collapse. LTCM survived long enough to wind down its position, but the fund was finished. The company that had once been considered nearly unbeatable disappeared. So what went wrong? Were the models bad? Not entirely. The mathematics wasn't the biggest problem. The biggest problem was believing that history would repeat itself. These models assumed that events this extreme were incredibly unlikely. But the markets don't read textbooks. They don't care about probability. Impossible happens. And when you're using too much leverage, one impossible event is all it takes. The collapse of LTCM changed Wall Street forever. Banks became more conscious about lending to highly leveraged hedge funds. Risk managers gained more influence. And the story became a permanent reminder that intelligence alone is not enough. Because in the financial markets, being brilliant doesn't make you invincible. Sometimes it simply makes you more confident than you should be. Follow me for more true stories that proves reality is often stranger than fiction. My name is Mamuz and I tell real forex stories. See you in my next video.